Welcome to the Deep Dive. Today we're doing an in-depth exploration of the Q1 FY26 earnings call for Ola Electric Mobility LTD, that's ticker OLAES. This was a really highly anticipated call and certainly delivered some surprising news that, well, the market clearly liked. Get ready as we unpack the numbers and the strategic shifts driving this whole story. Let's kick things off with the headline numbers. Ola Electric's first fiscal quarter of 2026. Okay, so the company reported revenue of 828 crore. That's roughly 8.28 billion Indian rupees, or around 100 million US dollars. And that was a significant beat against the consensus expectation, which was, 685 crore?
Yeah, decent beat. And diluted EPS, the loss per share, came in at managed 0.97. That was narrower than the 1.05 loss analysts were expecting. So better on both top and bottom lines, relatively speaking.
Okay, and deliveries?
Vehicle deliveries hit 68,192 units in the quarter.
And the profitability angle, I heard something big happen there.
Yeah, that's right. The auto segment actually swung to positive EBITDA, earnings before interest, taxes, depreciation, and amortization in June. That was a first for the company. And the overall growth margin expanded pretty notably to 25.6%.
Wow, okay. Positive EBITDA in auto. That feels significant.
It is. You're right. Well, this quarter, represented maybe a modest beat against street forecasts, which were frankly quite subdued. The market's reaction was anything but modest. A lot of people quickly marked this as the long-awaited operational inflection point for Ola Electric.
An inflection point. Okay.
Yeah, we saw a really substantial positive move in the stock price. Trading volume was exceptionally high. It signaled a clear relief rally for investors who've been watching this one.
That definitely sets the stage. Let's really dig in now. Let's unpack the specifics of what drove these impressive numbers and, crucially, what management is signaling for the future.
Okay, so that expansion of gross margins to 25.6% and the auto segment's positive EBITDA in June, those are absolutely pivotal. Management highlighted this, and they said it was a direct result of their strategic transition.
Transition? From what to what?
They've shifted essentially from an aggressive market penetration approach, growth at almost any cost, to a more balanced, profitable growth strategy.
Okay. Focusing on the bottom line now.
Exactly. And what's really critical here, a key takeaway, is that this profitability was achieved largely without relying on government incentives.
Right, without incentives. That seems like a big deal in the EV space.
It is. It's crucial because, many EV players have ridden that wave of subsidies. Ola's ability to operate profitably without them, well, it signals a more robust, sort of self-sustaining business model. It's less vulnerable to policy shifts, setting them apart from many peers.
That's a very strong differentiator then. So if incentives weren't the main driver, what exactly fueled this margin improvement?
Two main drivers they talked about. First, the new Gen 3 platform. Second, something they're calling Project LaGgeria.
Project LaGgeria. Sounds fancy. What is it?
Yeah, management described it as basically an internal efficiency initiative. It helps significantly cut operating expenses right across the board. The company also noted substantial structural improvements, things like working capital, inventory management, even warranty claims. It suggests a much tighter ship overall.
Tighter ship, okay.
And they indicated the auto business is stabilizing now, getting to, a reasonable level of maturity in both profitability and cash flow.
So less cash burn.
Much less. It's now expected to be operationally cash positive soon, and actually free cash flow positive by the end of this fiscal year, FY26. They figure it will consume only about 4,500 crore of incremental cash from here on out. That's a significant improvement.
Okay, that path to positive cash flow is huge. But to get there, companies often need big investments. What's their capital expenditure outlook? Are they planning a lot of spending?
Well, for the automotive business specifically, they said no major manufacturing or growth CapEx is expected in FY26.
No major CapEx. How are they improving things then?
Most of their capital expenditure is actually being capitalized R&D.
Research and development treated as an asset?
Exactly. It signals long-term investment rather than just an immediate expense, which helps their financials look better now.
Okay, but what about the cell business? The Gigafactory. That must need money.
It does, yes. That has planned CapEx. They've already completed 1,400 crore worth of work on a planned 5 GW capacity. The remaining euro 100 crore will be deployed this year and into next, and that's funded by an existing term loan facility.
And beyond 5 GW.
They don't foresee the need to expand the cell gigafactory capacity beyond that 5 GW for the next 3 to 4 years. That simplifies their future spending quite a bit.
Interesting. Okay, let's turn to the products themselves. You mentioned the Gen 3 platform. How's that contributing?
Right. So this past quarter was the first full quarter for Gen 3, and it already accounts for almost 80% of their total sales.
80% already. Wow.
Yeah, it's ramped up fast. And they're citing it as significantly better in performance, gross margins, and importantly, quality.
Better quality means.
Lower warranty claims, which directly helps the bottom line. In fact, they said Gen 3 claims are looking very good compared to Gen 1 and Gen 2. Plus, about 70% of the older Gen 1 products are now out of warranty anyway, so no more major one-time warranty provisions expected there.
Okay, that clears up a potential overhang. Any specific improvements in Gen 3?
A key one is the in-house motor. It apparently has a 90% lower failure rate than the Gen 2's motor, which they bought from a supplier.
90% lower failure rate? That's a huge jump.
Huge, and a real testament to their vertical integration strategy paying off in terms of reliability.
And speaking of new products, what about the motorcycles? The Roadster, how's that going?
Well, motorcycle deliveries only started in early June, so it's very early days. They're just beginning to ramp up.
But initial signs?
Initial feedback on the Roadster X and X Plus has apparently been overwhelmingly positive. The company is taking a very calibrated approach to scaling these up, though. They expect volumes to really spike around Navratri.
The festive season, right.
Exactly, as they roll them out to more stores.
And pricing. How do the bikes compare to the scooters?
The ASP's average selling prices for the bikes are broadly similar to their S1X and S1X Plus scooters, maybe 5 to 10% higher.
Okay, so broadly in line.
Yeah. And overall, their average selling prices across all products saw a 2% sequential increase this quarter. That was largely driven by that increasing mix of the higher margin Gen 3 products and also the really high penetration of their Move Plus software subscription.
Software subscription, how high is the uptake?
Nearing 70% adoption now, so that's becoming a nice recurring revenue stream too.
Okay, let's talk supply chain. We often discuss risks there, especially with critical stuff like rare earths for motors or upcoming regulations like ABS mandates. How's Ola handling these?
Right, and this is really where that vertical integration story shines again. For rare earth magnets, which are crucial for many EV motors, they have a dual strategy. 1, exploring alternate suppliers. 2, rolling out their own rare earth-free motors starting in December.
Rare earth-free motors, that gives them options.
Immense flexibility, and it hedges against potential price spikes or supply issues for rare earths.
And the ABS mandate, anti-lock brakes becoming compulsory.
Yeah, on that, they claim to be the only EV company with an ABS product already on sale. And crucially, they'll have an in-house ABS solution ready by the mandate timeline.
In-house ABS. So they're not buying it from Bosch or Continental like everyone else.
Apparently not. And this in-house capability means their ABS solution will cost them a small fraction of what the rest of the industry pays.
Wow, that's a direct cost advantage.
Exactly. Think about that. It adds directly to their gross margins. Management really hammered this point home. They said in-house development of critical bits motors, ABS electronics, software, and eventually cells provide substantial gross margin benefits. It makes them highly competitive even though they aren't necessarily charging higher prices than the market.
Okay, so operational improvements, in-house tech driving down costs. What does this mean for their future outlook? Did they update guidance?
They did. Given all these improvements, management raised their full fiscal year 2026 guidance. They're now targeting a remarkable 35-40% gross margin range.
35 to 40%, that's very high for auto.
It is ambitious. And they're aiming for sustained auto segment profitability. They're projecting 3.25 lakh to 3.75 lakh vehicle sales for the full year. That's 325,000 to 375,000 units. Driven largely, they think, by the festive season coming up and the continued ramp-up of Gen 3 and those new bike products.
This sounds like it reflects a broader shift, maybe in the whole Indian EV market too. What's their take on industry penetration? Is the crazy growth phase over?
Well, according to management, the industry is entering what they call a consolidation phase. This follows that initial period of hypergrowth.
Consolidation, okay.
Now, EV two-wheeler growth at around 20% year on year is still way faster, like 3 times faster than traditional ICE, internal combustion engine, two-wheelers. Those are growing at maybe 6-7%. But the pace has definitely slowed from those earlier, really aggressive growth rates we saw a year or two ago.
Why the slowdown?
They attribute it mainly to reduced government incentives, which we talked about, and also the fact that the early adopters, the real enthusiasts, have largely made their purchases already. The middle customer, as they put it, is now more cautious. They're waiting for more validation, more market maturity before jumping in.
Makes sense. So what's the long-term view?
They expect an S-curve play out, initial aggressive growth, then this consolidation phase we're in now, followed by another aggressive growth phase in the near future as EV adoption hopefully goes truly mainstream.
Got it. And the Gigafactory, the cell production, that's such a huge piece of their long-term strategy. What's the latest there?
Yeah, it's critical. They said the cell gigafactory is actively ramping up. And importantly, it's producing cells for actual vehicles now, not just test cells anymore.
Oh, so cells made in-house are going into bikes and scooters soon.
Yes. The first vehicles equipped with their new 4680 cells, that's the larger cylindrical battery format like Tesla uses, those will be delivered to customers by Navratri. They promise more details on August 15th.
August 15th, okay. And the economics of the Gigafactory. Can they really make cells cheaper themselves?
The company believes that at that initial 5 GWh capacity, their cell business will be free cash flow break-even. And yes, cheaper than procuring cells from outside suppliers. And that's even without considering potential PLI benefits, the production-linked incentives from the government.
What about efficiency? Making batteries isn't easy.
No, it's not. They acknowledge that current cell yields, basically, the percentage of usable cells they get from the raw materials are around 60%. Not great, but maybe expected at this stage. They're targeting a break-even point needing about 3.5 to 4 GW of capacity, running at a yield in the low 80% range. So, still some way to go on efficiency.
And the PLI scheme. There were reports they might miss deadlines.
They clarified that. They said while they likely won't meet the initial 20 GWA PLI timeline set by the government, their profitability case for the Gigafactory doesn't actually rely on getting those incentives. And the maximum penalty for missing the timeline is around 100 crore, which they're already accruing for, basically setting the money aside.
So the strategic reason for the Gigafactory isn't just subsidies?
No, not primarily. The strategic rationale is very clear. Long-term business continuity, controlling your own supply chain, and leveraging cell technology leadership. Because, as they emphasized, cells are definitely not a commodity. Owning the tech is key.
Right. Okay, quickly then, any updates on their direct-to-customer network, their stores and service?
Yeah, they've expanded their DTC presence quite a bit already. But the focus now has shifted. It's less about just opening more stores and more about institutionalizing operations, meaning optimizing the existing stores, improving the customer experience, and boosting productivity within that network, making what they have work better. They've apparently already seen gains from reducing inventory held in the network and expect more improvements going forward as they refine that retail strategy.
Okay. And one last crucial point, debt. What's the company's current debt situation look like? Investors always worry about that.
Sure. So excluding short-term working capital debt, their gross debt stands at around 2,000 crore, and they're actively paying that down over the next 2 years.
Okay. And cash on hand?
They have 3,200 crore cash on the balance sheet right now, so more cash than debt, which is a healthy position. They also got board approval to issue fresh NCDs, non-convertible debentures, basically corporate bonds, to refinance some of their existing corporate debt, likely at better terms.
So do they need to raise more money?
Crucially, management stated they do not foresee the need for any more cash than they currently have on hand.
That's a strong statement.
It is. And it's also worth noting, they mentioned that some of the IPO funds that were originally earmarked for capacity expansion beyond that initial 5 GWh, well, that money might now be redeployed into other productive uses, reflecting this refined, more focused strategy they have now.
Okay. So, stepping back.
Yeah.
What's truly compelling here, it seems, is how this quarter's performance and everything management said. It paints this picture of a company potentially hitting a really significant inflection point.
I think that's fair. After a pretty tough period, characterized by those subsidy rollbacks and a big share price decline, these results strongly suggest their strategic shift focusing on profitable growth, leveraging that deep vertical integration. It really seems to be starting to pay off. It feels like a moment of validation.
Which brings us to the listener. What does this all mean for you, especially if you've been watching the Indian EV space, which has been, well, volatile?
It really suggests a potential re-rating for Ola Electric is on the cards. They're solidifying a genuine cost advantage through all this in-house tech, the motors, the ABS, the upcoming cell production. That positions them uniquely in a market that's likely consolidating.
And how did peers react? Did other EV stocks jump too?
Well, peers in the domestic EV space did see some positive movement after Ola's results, but they significantly lagged Ola's surge. which suggests the market is specifically recognizing Ola's operational improvements and perhaps its strategic depth. It wasn't just a sector-wide lift.
Interesting.
Yeah, so this could really be a signal of a new trajectory for them, moving away from that high growth at any cost model towards, sustainable, profitable leadership.
Okay, here's where we pivot. It's time for our not financial advice segment. We put on our imaginary hedge fund analyst hats and pitch an outrageous but maybe plausible trade idea based on everything we've just discussed from this earnings call. Your turn.
All right, my pitch for you, it's a pair trade. Go long OLAELEC, bet on its stock price going up, and simultaneously go short bet on their prices falling a basket of traditional Indian ICE two-wheeler OEMs, the old guard, or maybe even some of the smaller, less integrated EV players.
Long Ola, short incumbents, and weaker EV players.
Okay, the thesis.
The thesis is pretty straightforward, based on everything we've heard. Ola Electric's deep vertical integration, that Gen 3 platform, developing rare earth-free motors, the in-house ABS, and especially the imminent 4680 cell production, it creates a structural long-term cost advantage. It should allow them to achieve and sustain those projected gross margins of 35–40%. That's something the traditional players burdened by legacy systems and supplier dependencies simply can't easily replicate. Same for smaller EV firms without the scale or tech. So cost advantage drives margin and market share gains.
Exactly. As the Indian EV market consolidates, Ola is uniquely positioned, I think, to capture a disproportionate amount of market share and do it at superior margins. And here's the kicker, the timing aspect. Despite this recent rally, the stock has clawed back some losses, sure, but it's still, 70% below its peak back in August 2024? That presents a significant re-rating opportunity as the market, perhaps slowly, truly grasps the long-term profitability unlocked by these in-house capabilities.
So the market hasn't fully priced it in yet, you think?
Potentially not the full extent of it. This isn't just about a temporary product cycle boost. It feels more like a fundamental structural shift in their cost structure and their competitive moat. That's the long play.
Okay, quite the pitch. So wrapping up this deep dive into Ola Electric's Q1 FY26 results, it has certainly revealed a compelling narrative, a company at potentially a major turning point. We've seen that unexpected top-line beat, a much clearer path to profitability with expanding margins, and these strategic tech advancements that seem designed to create a real long-term competitive moat.
Absolutely. That decisive shift towards profitable growth, you couple that with their unique vertical integration. It positions Ola Electric to potentially navigate this evolving EVS curve with much greater resilience and maybe solidify its market leadership.
So the final thought, the big question this leaves us with, as that EVS curve continues to evolve, could Ola Electric's deep vertical integration controlling everything from motors to cells not only shield them from macro shocks, but could it actually end up redefining profitability expectations for the entire auto industry, at least in India? Something to definitely ponder. And as always, remember, this is absolutely not financial advice, just analysis and ideas. Thank you for joining us for this deep dive. We look forward to hearing your thoughts and questions.